Hey everyone, friends, brothers, and sisters. Welcome back to Boss Economics World, the only show that peels back the glossy PR of global finance to show you the bare-knuckle brawl happening in the back alleys. Today is October 7th, 2025, and let me tell you, the autumn chill in Washington and Brussels has nothing on the Cold War brewing between their financial regulators. You might think the biggest battles are fought with tariffs, tech sanctions, or on the fields of geopolitical influence. But I'm here to tell you, the most vicious, most expensive fights are happening right now, hidden in plain sight, inside the mind-numbingly boring pages of banking regulations. And this one, my friends, is a doozy. It's a story of jealousy, hypocrisy, and a multi-billion-dollar game of chicken. Buckle up, because we're diving deep into the great GSIB schism. Alright, before we get to the juicy drama, let's do a quick level set. What in the world is a GSIB? Think of the global financial system as a giant, interconnected Jenga tower. Most blocks are small, you pull one out, the tower wobbles a bit, but it stands. But some blocks are massive, foundational pieces. These are your globally systemically important banks, the JP Morgans, the BNP Paribas, the Deutsche Banks of the world. If one of these behemoths gets a little shaky and tumbles, it doesn't just wobble the tower, it brings the whole damn thing crashing down. We all saw this happen in 2008 with Lehman Brothers, which, ironically, wasn't even at the top of the too big to fail list at the time. After that global heart attack, regulators from around the world got together in a Swiss city called Basel and said, never again. They created the GSIB list, the official VIP club for banks so massive and interconnected that their failure would be a global catastrophe. But getting into this club comes with a price, a very expensive one. It's called the GSIB buffer or surcharge. It's basically a set of golden handcuffs. The regulators tell these banks, congratulations, you're a VIP. Now, because you pose a systemic risk, you have to hold way more extra capital, pure, high-quality equity than your smaller competitors. This capital is a safety cushion, a financial shock absorber. It's money that can't be paid out in massive bonuses or dividends, it just has to sit there, acting as a buffer against losses. We're talking about billions, sometimes tens of billions, of dollars in extra capital for each bank. How do they decide how big your handcuffs should be? The Basel Committee devised a scoring system based on 5 categories: size, complexity, interconnectedness, substitutability, and this is the crucial one for our story, cross-jurisdictional activity. Basically, the more business you do across national borders, the more complex and risky you are deemed to be, and the higher your capital punishment. It's a global standard. A gentleman's agreement. Or so we thought. Now, let's hop across the pond to Europe. The Europeans, especially since the sovereign debt crisis of 2011 to 2012, have been on a quest to build a banking union. The grand idea is to make the entire Eurozone act like one single country for banking purposes. One supervisor, one rulebook, one resolution mechanism for failing banks. It's a beautiful dream. In 2022, they managed to convince the Basel Committee of this dream. They argued, hey, a loan from a French bank to a German company shouldn't be considered cross-border anymore. We're one big happy family in the Eurozone. It's a domestic transaction. And the Basel standard setters, in a moment of perhaps wishful thinking, bought it. They agreed to treat the Eurozone as a single jurisdiction for calculating that GSIB score. Poof. Just like that, Europe's biggest banks got a massive regulatory discount. A cheat code, if you will. Let's look at the star pupil, BNP Paribas of France. When this rule kicked in, their cross-jurisdictional activity score plummeted. According to the Banque de France itself, this single change was enough to drop BNP into a lower risk category. Their required GSIB buffer was slashed by 0.5 percentage points. Now, half a percentage point might sound like chump change to you and me. But for a bank with a balance sheet of over 2.6 trillion euros, that translates into a massive capital release. To reverse the change today would force BNP to find an extra 4 billion euros in capital. That's 4 billion euros that is currently being used to generate profits, make loans, and compete globally. Italy's UniCredit and others also got a nice little haircut on their requirements. But here's the punchline, and it's a good one: the European Banking Union is a joke. And the Europeans themselves are the ones telling it. American regulators are now pointing out, quite correctly, that this single market is more of a Potemkin village than a reality. Where is the single, Europe-wide deposit insurance scheme? It doesn't exist. If a bank in Italy fails, German savers aren't on the hook, and German politicians will fight tooth and nail to keep it that way. The infamous doom loop between weak banks and weak governments that we saw in Greece and Italy is still very much a threat. A recent report from AFME, a major European financial lobby group, laid it bare: capital and liquidity are still trapped within national borders. A bank's subsidiary in Spain can't easily use its excess capital to support its parent in France during a crisis. Cross-border bank mergers? Forget about it. They are politically and practically impossible. Even Mario Draghi, the man credited with saving the euro, delivered a scathing report just last year. We're at the one-year anniversary now, warning that Europe's lack of financial integration makes it a punching bag for the US and China. So, the Americans are saying, you can't have your cake and eat it too. You can't claim to be a single market for the GSIB discount while operating as 20 separate, fragmented markets in reality. On the surface, they have a rock-solid point. But, my friends, in economics, the surface story is never the real story. This is where the plot thickens. Why is the Fed picking this fight now? Is it purely out of a noble desire for regulatory purity and a truthful reflection of risk? Come on. This is global finance, not a monastery. The real reason is dripping with good old-fashioned American self-interest and a healthy dose of sour grapes. You see, while the international Basel rules are the global blueprint, the US decided to gold-plate them. They took the Basel framework and made it even tougher for their own banks. Their version of the GSIB calculation, known as Method 2, is universally loathed by Wall Street, and for good reason. It contains a fatal, almost idiotic, design flaw. One of the key inputs in the US GSIB calculation is tied directly to nominal GDP growth. Think about that. As the American economy grows, which it is designed to do, the denominator in the risk calculation gets bigger, which mechanically pushes the bank's GSIB scores higher and higher every single year. It doesn't matter if the bank is actually becoming less risky, or if its growth is slower than its peers. The tide of the US economy simply rises, and the capital requirement water level rises with it, threatening to drown them. It's like a running race where officials move the finish line further away every time the economy takes a step forward. It's insane. The International Basel method is far more logical. It measures a bank's riskiness relative to the overall size of the global banking system. So, if you grow faster than your rivals, your score goes up. If you shrink, it goes down. It reflects relative risk, not an absolute, ever-escalating number. When the US rules were written post-crisis, regulators promised they would periodically rebase or adjust the economic factors to prevent this endless escalation. Guess what? They never did. The political will was never there. So, US banking giants are trapped. Let's put some hard numbers on this, because this is where it gets staggering. Based on the latest available data from year-end 2023 and extrapolating the trend, the gap between what US banks pay and what they would pay under the international standard is astronomical. For JP Morgan Chase, the difference is nearly $40 billion in locked minus up equity capital, $40 billion for Bank of America, it's another $26 billion. For Citigroup, it's in the same ballpark. We are talking about a competitive disadvantage north of $100 billion for just the top 3 or 4 US banks compared to their European rivals. Jamie Dimon, the CEO of JP Morgan, has been complaining about this for years, calling it patently unfair and not risk-based. He's right. This isn't about safety and soundness anymore, it's a punitive tax that only hits American champions. So what's the solution? The logical thing would be for the US to scrap its flawed Method 2 and just adopt the international Basel standard, right? Wrong. Politically, that's a suicide mission. Can you imagine the headlines? Trump/Biden administration gifts Wall Street a $100 billion bailout. Regulators weaken rules for too big to fail banks. In a populist political climate, a move that would release that much capital back to the fat cat bankers is simply a non-starter. It looks like a massive giveaway, even if it's just a correction of a bad rule. And this brings us to the core of the strategy. If you can't get your own golden handcuffs loosened, what's the next best thing? You try to tighten your rivals. The US regulators, unable to fix their own domestic political problem, are looking across the Atlantic. They see BNP Paribas and others getting a sweet deal based on the fantasy of a banking union. And they've decided to call Europe's bluff. It's a classic diversionary tactic. By attacking the legitimacy of the EU's GSIB discount, they achieve two things. 1. They level the playing field by trying to force European banks to hold more capital, closing that competitive gap. 2. They create a powerful bargaining chip. They can go to international forums and say, look, we're all about fair and consistent rules. If you want us to even consider reforming our tough domestic standards, you Europeans need to get your house in order first. It's a brilliant, if cynical, piece of geopolitical hardball disguised as a technical regulatory dispute. So, let's zoom out. Why should you, an investor, a professional, or just a curious citizen, care about this alphabet soup of SIBs and Basel rules? Because the seemingly obscure fight is a symptom of 3 much larger, and much more dangerous, trends. First, the weaponization of financial regulation. We are moving beyond simple trade wars. The new battlefront is the global rulebook itself. The US is using its regulatory power not just to ensure stability, but to actively pursue a competitive advantage for its domestic industry. It's a form of protectionism cloaked in the language of prudence. This sets a dangerous precedent. What happens when China decides to do the same with its own banking rules to favor its state-owned giants? The global consensus on financial stability, painstakingly built after 2008, begins to fray. Second, the great regulatory unraveling. The text mentions we've entered an era of simplification and dismantling of some safeguards. This is critical. For a decade after the crisis, the pendulum swung hard towards more and tougher regulation. Now, under pressure from industry lobbying and a collective sense of fatigue, it's swinging back. We are seeing proposals in both the US and Europe to ease the burden. But have we forgotten the lessons of history so quickly? The 2023 banking turmoil that saw the collapse of Silicon Valley Bank, Signature Bank, and the emergency rescue of Credit Suisse was a brutal reminder that the system is still fragile. Those failures happened in a world of stronger regulation. What happens if we systematically weaken the guardrails? This GSIB fight, in a way, is a sideshow distracting from the bigger trend of a global, creeping deregulation that could sow the seeds of the next crisis. Third, and perhaps most importantly, the enduring flaw of the European project. This incident brutally exposes the fundamental weakness of the European Union. It wants the economic benefits of a superpower, a single market, a reserve currency, without the necessary political integration. The lack of a true, fiscal, and banking union with shared liabilities is a permanent vulnerability. The US knows this. China knows this. And they will continue to exploit these internal European divisions for their own gain. Until Europe decides to become a true federation, it will remain a collection of powerful economies that is, paradoxically, less than the sum of its parts. So, who is the good guy in this story? The answer is, no one. The Europeans are benefiting from a regulatory fiction, papering over the deep cracks in their vaunted banking union to give their champions a leg up. The Americans are cynically exploiting that fiction, not out of a pure desire for truth, but because they are politically unable to fix their own badly designed, punitive rules that hamstring their own banks. This is a clash of self-interests, a high-stakes poker game where the chips are the stability of our global financial system. The likely outcome? A messy compromise after months of backroom negotiations, where the Europeans are forced to concede something, and the Americans claim a victory, while the fundamental problems on both sides remain unsolved. The real takeaway for all of us is this: the era of cozy, post-crisis global cooperation in finance is over. We are now in an age of regulatory nationalism and strategic competition. The next time you hear a central banker talk about global standards and a level playing field, remember this story. Behind the diplomatic language, it's a knife fight in the dark. And we, the public, are the ones who will pay the price if one of them slips. Alright, that's the world according to Boss Juan for today. Think about it. In economics, the rules of the game are the game itself. Always follow the money, but more importantly, follow who's writing the rules. This is Boss Economics World. I'll see you next time.